When we talk about how to buy stocks, knowing how to appropriately size your position is a key component of portfolio management. And even more importantly, knowing how to handle that position over long periods of time is an invaluable investment skill. You may hold a given stock over a period of weeks, months, or years, and the size of that position in your portfolio may shrink or grow depending on the surrounding market conditions as well as the individual stock's performance. So let's start at the beginning. There are various ways to determine an initial position size based on your conviction in a given stock and the market. Once you have that initial position, you can add to it as the stock passes new bullish entries or pulls back. Ultimately, position sizing is a personal decision as everyone has their own risk tolerance. It depends on several factors like your overall portfolio size, personal risk tolerance, your age, how well your portfolio is performing. All of these are influencing factors to consider. One way to approach initial position size is by determining how much per trade you're willing to risk. So say you're willing to risk 1% of a $100,000 portfolio per trade. That works out to a loss of $1,000 per trade. Our 8% loss rule has us cutting our losses when a given position loses 8%. So to figure out the dollar size of a position where an 8% loss equates to $1,000, we could divide 1,000 by 0.08 and we get 12,500. Therefore, the total amount invested in any given stock at full position size would be 12,500. Another method of determining position size is by limiting any given position to 10% of your overall portfolio. So say that you've decided the total number of stocks that you want to own at any given time is 10. Then for a $100,000 portfolio, a full position would be $10,000. The total number of shares that you can afford of a stock will depend on that stock's individual stock price. So this way you limit the total number of stocks in your portfolio to 10 max at full position. The thing about IBD's investing philosophy when it comes to portfolio management is flexibility. We don't have to start a position at full size. Perhaps overall market conditions are volatile, uncertain, or we don't have total conviction in a particular stock. We just want to start a smaller position to test the waters. Starting a half or quarter size position in this case makes perfect sense. So for a $100,000 portfolio, that would be $5,000 for a half and $2,500 for a quarter size position. So now that we've established how initial position sizing works, let's get into how to trade around this position over time and manage a stock through the ups and downs. Perhaps one of your positions really starts to take off and you get another chance to add after it's had a nice move higher. Say a stock had a nice move from 25 to 40, then it pulls back to 35. From here, the stock tests support and bounces from its 10-week line and starts off again on a second rally. You could consider adding to your position, going from 10% and adding another 2.5 or 5% to compound your gains as the stock rallies again. This is an example of how adding to a core position can help you amplify your gains by buying into strength and investing more in the stocks that are really working for you. Do not be afraid of sizing up on subsequent bases and breakouts from that initial position. Just remember to keep your follow-on buys smaller than your initial purchase so you don't drive up your average cost too much. After your initial buy, the first add-on point is typically a bounce off the 10-week line. These add-on entries are highly probable and tend to work consistently in stocks that are showing institutional support. If the stock is breaking below the support level, it goes from being a leader to a laggard and may not be worth adding to, as long as you're doing everything you can to try and add more money to the stocks that are working. So let's take a look at an example using IBD's charting tools. Looking at Zoom stock back in early 2020, right before the pandemic broke out, and Zoom became one of the most important tools for business around the globe. Shares formed a cut base with a 107.34 buy point. Savvy investors could have started a small position, maybe 2.5% or 5%, as the stock moved above short-term resistance at around 96.50 during the week of February 21st. Later that week, the stock swiftly broke out from a traditional entry in very heavy volume. At this point, you could have added another half to your position or Maybe you were cautious given the uneasy market environment and only added 2.5%. The stock then rallied sharply and reached the 20% profit zone. However, amid a volatile market environment, shares frequently crossed back below the traditional buy point, underscoring how important those early entries can be. So say you held through the initial volatility as the breakout got going. Shares then reached a high of 164.94 during the week of March 27th. That represented a gain of 70% from the early entry and 53% from the traditional buy point. It may have made sense to lock in some profits as shares initially reached the 20% profit zone and as the stock became well extended above its 10-week line, while still holding onto a core position. Then, during the week of April 3rd and April 10th, shares pulled back to support at the 10-week line, which was around 114.31. The stock even crossed below this area intra-week to a low of 108.53, very close to that traditional entry. But shares ultimately closed near intra-week highs and safely above the 10-week line, offering aggressive investors the opportunity to add to the position. The stock then took off again to new highs of 181.50 before pulling back once again to the 10-week line during the week of May 1st and May 29th. Another path you could take is selling into strength and taking gains as the stock moves higher. Perhaps you have a 10% position, and as the stock hits various sell points like the 20% profit zone or becomes 10% extended from the 10-day line, you sell in quarters or thirds, taking some profits as you go. Then, once the stock forms a new base, you can add back shares and ride the next rally higher. The tricky thing can be knowing which route to take for a given stock. If a stock is one of the leaders in the market and it's garnering a lot of attention, it may make sense to try and let it run. However, it can always be smart to take at least some of your profits when it appears to be getting extended. Perhaps it gets 10% above the 10-day line or even the 21-day line. This may be a sign that it's now extended and is about to pull back or trade sideways to digest the gains. Remember, to have any big winners, you have to give it room to run. If you're selling your entire position at every 10% or even 15% pullback in a stock, then you'll never have a big winner because they're all going to do that at some point in their rally higher. The key is to have built enough of a profit cushion to be able to withstand the pullbacks, or use the method of taking partial profits if the stock is showing real weakness. We don't just want to sell a stock entirely unless it's showing definite signs of trouble. Once you lose it from your portfolio, once you take it off your trading screen, it is very easy to miss the stock's next run higher. Depending on what's happening in the overall market environment, another way to work your position size to your advantage is to find an area of the market that's really working. We often speak about industry group rotations where one or two groups in particular are showing leadership. Perhaps there are multiple stocks in this group that are looking really strong. So rather than start one 15% position in just one stock, you could choose 3 of the most compelling names and start a 5% position in each. Then let the market show you which horse to put more of your money on. If a few weeks later, one of the 3 is clearly outperforming, then you'd scale up your position as the stock triggers additional add-on buy signals, like breaking above a 3 weeks tight, bouncing from the 21-day line, or breaking above a short-term resistance level. You can scale out of the positions that aren't performing as well and then shift your capital to the one that's leading. Position size is very important and very personal. Many investors consider it one of the most important aspects of portfolio management. Knowing how and when to scale up can be a game changer for your investing. If there's one word to describe a good portfolio management style, it would be flexibility. The bottom line is, it's best to try and avoid all or nothing decisions when managing your portfolio. Unless a stock is acting very poorly, you want to try and scale in and out incrementally. This allows you to build profits in a core position over time that can eventually become one of your big winners.